Coyne, Executive Vice President at Sprott Asset Management. With me today is one of our senior portfolio managers, Trey Reik. Trey, at Sprott, we always like to say that gold is really the original alternative investment. Many investors tend to lump gold, however, into the commodities bucket. In your mind, how should an investor think about gold?
Well, technically, obviously, gold is a commodity, and it's about 5% of most commodity baskets or indexes. So gold is clearly, tangibly a commodity. Interestingly, however, because gold's commodity use is primarily the manufacture of jewelry, which isn't the most compelling investment thesis, to me, clearly the investment merits of gold or portfolio merits rest far more on its monetary characteristics. And in fact, when gold separates from the commodity pack, it's generally an indication that the market is coveting those monetary characteristics. There are a lot of aspects to gold production in the industry itself, which also differentiate gold from any other commodity. The difference between gold and other commodities is all the gold ever mined is still with us in some form above ground, whether it's jewelry or in a museum or, frankly, in teeth. So gold doesn't have any feedback loops based on supply and demand because the above ground stock is so large. But the fact that that above ground stock is so large and relatively constant makes gold a good form of money or store of value. It can't be debased or defaulted upon, manufactured like, for example, fiat currencies. Last things would be most commodities are more linked to the business cycle because of their industrial uses. And I might even go out on a limb and say in a depression, commodities have a tendency not to perform well, whereas gold's monetary characteristics give it more of a binary nature insofar as it can perform in an inflation and also in a deflation when debt is defaulting. So gold's true use, I really think, stands by itself as the world's primary monetary asset.
Well, and that brings up a good second point. From a monetary standpoint, when trying to optimize gold and its ability to add value in a portfolio, what would you say should be the approach when you're trying to maximize your risk-adjusted rates of return and using gold as part of that allocation?
Good question, and we've spent a lot of time analyzing, say since 2000, the returns of gold vis-a-vis other alternative assets that are available to both individual and institutional investors. The real key word, I think, in the last couple of decades has been non-correlating asset. That's what everybody's looking for. It's the holy grail. And gold, interestingly, is one of the only things in the world, one of the only asset classes that's really correlated very little to everything else other than its negative correlation to the US dollar. So interestingly, over the past 18 years, and we studied the most prominent alternative asset indices, those indices have averaged an annual return of about 8.5%, and gold's annual return, coincidentally, is about 9.5%. And the interesting thing is that 9% of return is far less correlated to other traditional asset classes than even the most sophisticated of the alternative asset indices. So the indices that we measured on average had an 80% correlation to equities and only an 8% correlation to gold, so about 10 times higher. But in terms of the average portfolio, using basic building blocks, stocks, bonds, cash, an allocation in the gold area of about 2, believe it or not, to 9% maximizes returns over time, again, because of its non-correlating nature, gives portfolio protection. 2% would be the necessary gold component for, say, a 20% equity, 80% fixed income conservative type of stance. And then on the other end of the spectrum with, say, 80% equity, 20% fixed income, you would need a larger gold allocation to counterbalance the volatility and risks of the equity portion. So you might have about as 9%. And then if you introduce all the other alternative assets themselves, like hedge funds, real estate, commodities, it's interesting that gold still maximizes risk-adjusted returns at about a 3.5% weighting. So all indications are, under normal circumstances, something on the order of 5% is likely to increase risk-adjusted returns. And I would say that's under normal circumstances. And
right.
I would call the current situation anything but normal.
So sure.
Reach your own conclusions.
Right. Well, let's shift gears then, because we've talked a lot about gold and gold as an alternative and looking at it and constructing a portfolio. How about gold equities, right? You hear a lot about gold, but how about gold equities, and how should an investor or an allocator think about allocating capital to both gold and gold equities, and what would that look like in a portfolio?
So I always mention to individuals or family offices, et cetera, that the first 20% of any gold allocation should really be in an accessible physical form like coins. That may sound a little funny or anachronistic, but a coin allocation really does serve a lot of purposes. It's identifiable, it's portable, it's accessible. You can get to your coins when stored in your home or in a bank, move them around the world or the country. And everyone everywhere in the world knows what a U.S. Sovereign eagle looks like, and it's really as good as money in almost all countries around the world. The next sort of 50% I would think would make sense in a bullion vehicle. I think the Sprott physical bullion trusts are clearly the best product in the marketplace because they're eligible for long-term capital gain tax treatment, unlike gold itself and some of the competing products. And then at the tail end of the allocation, maybe 25% or 30%, I think should be considered for a commitment to gold equities. There is a disclaimer I must mention, which is that gold itself is volatile, and gold equities, which to a degree are an option on gold itself, and they have enormous leverage to the gold price, beta to bullion leverage, we call it in the biz. But gold stocks, if gold increases 10, 20%, gold stocks will double or triple. So they're volatile, but they're a very, very important tactical allocation to maximize returns in an upward cycle for the gold price. Coincidentally, today, gold stocks are the cheapest they've been versus the underlying metal in probably 3 decades. So having declined quite a bit from the highs of 2011, I think it makes a lot of sense for a portion of the gold allocation, but only after the first two. In other words, you need to have your gold first, and once you've got that tied away or taken care of in the portfolio, then I think it makes sense to have a little bit of a sweetener with the gold equity exposure.
Yeah, I like thinking of it as a sweetener. I always like to say, gold's really a core allocation, and then from a tactical standpoint, adding in or sweetening that allocation with gold equities makes a lot of sense. Well, we appreciate you taking the time to listen to us today, and to learn more about Sprott and our view on precious metals and the suite of offerings we offer at Sprott, please visit us at sprott.com. Thank you.